2020 has been a challenging year for all of us, and some of you might be thinking about going into forbearance. Hello everybody, my name is Barry Horvath and this is Moving Forward TV with your local market update.
And I am DeLynn Gaston. Thank you so much for joining us today. So as usual, in the mortgage world, things are changing again. So we have given you guys lots of updates regarding forbearances, and because we do have a lot of people struggling right now with their mortgage payments and things like that. And we've been talking about forbearances. Well, the rules are changing again, so we wanted to give you a brief update on that.
There's a lot of things changing every day. We actually have a huge economic shift right now going on because a lot of people, certain segments are hurting right now. The entertainment world is hurting. The restaurant, anything hospitality is hurting right now. People are doing staycations and not flying, so the airline industries are hurting. So hours are being cut, and we hate to paint the doom and gloom, but there's just not a lot of work for a lot of people right now going on. So sometimes you have to make hard decisions out there. So
we understand they're hard.
Yeah, but you know what? The first choice, in my opinion, if we're talking about forbearance, is always see if you can refinance.
Right.
Even though the guidelines
before going into forbearance.
Before going, because you could really benefit possibly, I always say possibly, take a look at your situation from these low interest rates. I can't believe how low rates are.
And
it's
lower
crazy.
your payment by a couple $100. And just for what it's worth, anyone who has refinanced before, you know this, you always skip at least one payment. So you're going to get a little bit of a breather in there anyway. Now, don't get me wrong, it's hidden in there somewhere. But the bottom line is you skip a payment, and sometimes two payments depending upon what time of month you close.
Yeah, everybody says, oh, my closing costs are this much. And we're like, oh, you don't have a mortgage payment next month. Oh, cool.
Yeah. So, I mean, like I said, and sometimes it's even 2 months. Like the month you close, if you close early enough in the month, and then the following month. So that right there, instead of a forbearance, maybe, like Barry said, look at possibly doing a refinance before you go into forbearance, because that might be helpful. And that's long-term. Sure, forbearances are short-term fixes.
That's a short-term, quick fix solution. Right. A refinance, you could potentially pull out cash. Maybe because of the hardship, you started running up credit card debt.
Right.
Cash out can be pulled to pay off that debt, that high interest credit card debt. Or maybe you took a consolidation loan that wasn't a great idea, that you panicked and signed the back of that check. You ever get those in the mail?
Oh, all the time.
Yeah. So
I shred them.
Yeah. So people get wrapped up in some of these high interest fixes. Maybe a refinance will work for you, and sometimes you don't even need money out of pocket to do it, because appraisal waivers are happening. Even on the cash out refis now, we're seeing appraisal waivers, which means you don't have to pull any money out of your pocket, not even the cost for the appraisal. So
it's an option before you go to forbearance, because the forbearance things are changing again, and it has to do with how long do we have to wait after we come out of forbearance. Because if you're already in forbearance, we can't do a refinance. Unfortunately, the guidelines are pretty strict with that, and no refinancing while you're in forbearance. You have to be out of forbearance in order to do the refinance, and we cannot do a cash out refinance to catch up your payments on the forbearance. They're pretty strict and hardened rules on that.
And even though a forbearance on paper may sound appealing, and a lot of the servicers are asking people, hey, do you want to? And some people are taking them that don't even need it. Just remember, there's no such thing as a free lunch, because if you go into forbearance, there are repercussions on the back end. You are going to have to pay that back eventually, sooner or
It's
later.
not free payments.
It's not free payments. Even though the CARES Act says we cannot foreclose on you, you will have to make payments. The current guidelines are right now, if you go into forbearance, you must make at least 3 payments in order to be eligible to refinance or even purchase another home. You know, even if it's another home you want to do outside that you didn't even do the forbearance on, and you find this awesome deal,
Right.
below market investment property that you've been after, you won't be eligible to get it. So keep that in mind. So you will have to make 3 payments consecutively on time, be caught up on that forbearance to be allowed. Now, prior to the CARES Act, it was actually 1 year.
So, right, so it's catch up, let's say you took a 3-month forbearance, so it's catch up those 3 payments plus waiting another 3 months. So I just want to make sure that's clear, that people think, okay, well, I caught up the 3 months and I can do it now. No, you can't.
Right. So and prior, like I said, prior to the CARES Act coming in and all this COVID stuff, it was actually 12 months before. So that means you had to make 12 monthly payments in order to be eligible for refi. So it's better now, but it's still there.
Right.
Now, there's
So
other...
this is their way of helping. Now, so let's talk about the normal things for forbearance that we have been telling you for the last several months, that, you know, since COVID started.
And if you don't like what we're telling you, wait a minute.
Yes, since COVID started and they started doing forbearances. So every lender does it a little bit differently, but for the most part, let's say you did a 3-month forbearance. During that 3-month forbearance period, and then it's over at the end of 3 months. So let's say you did June, July, and August. Well, guess what? September 1st, you now owe June, July, August, and September. So back then, they were not tacking them on to the end of your loan, and a lot of people thought that they were. Well, I don't have to worry about paying this for 30 years. It goes on to the back of my loan. No, in most cases, 95% of the cases out there did not go to the back of the loan. However, because so many people were shocked by that, apparently they weren't listening to our show.
Right.
People were shocked by that. Well, come month 4, right? So come September 1st, now they owe those 3 months, plus they owe September. So they owe, well, who has 4 mortgage payments when we're still in the middle of this and people,
those people were in a hardship to begin with.
Right. So chances are they don't have that. So lenders started changing a little bit.
So now... one of the options is, yes, some lenders, servicers, and it'll be up to your individual servicer, we're starting to see them come out, will tack it on the back of the loan. But what they're also doing now that we didn't know, remember the unknowns, is they're creating a second mortgage that they're tacking on. So while that's great, it's still another loan that you're going to have to pay back. It is tied to it. Now, here's the bad news about that. Your refinance, if you do one in the future, will always then be considered a cash out refinance if you consolidate a first and a second loan. And you say, well, what's the big deal?
And
well,
that is a second loan.
It is a second loan. So if you do...
Interesting.
Yeah, because if you're doing a cash out refinance...
Now, this is all new, so this might change too. So
a cash out refinance does have an adjustment to the rate, which will be a higher rate because it is a higher risk to the investor. I like the inventor, but the investor than just a rate in term, meaning you're just paying off your existing mortgage. You are going to get the best rate at a low loan to value.
So, the other thing that I was just thinking of too, I wonder, if they already had a HELOC?
Now they have a third.
Now,
loan.
is it going to be a third
It
loan?
will be a third. It'll be in third lien position, yes. So,
interesting.
yeah, there's going to be a lot of different scenarios coming out.
And like we said, this is going to vary lender to lender. Some lenders aren't going to do this. Some lenders are. Basically what the mortgage industry has realized is people can't come up with 4 months worth of payments or 5 months worth or 6 months worth of payments because we're still in the middle of this pandemic. So, and things are, although a lot has come back, a lot hasn't.
And I think the servicers right now are going to be scrutinized because they cannot foreclose.
Right.
But as soon as that's all lifted, some of them are going to come out swinging and going to look to foreclose.
I know.
Because they want their money. They need that. They need those payments.
Right.
They do. They have to pay that end investor. So, there's a lot more we don't know than we do know of what's going to happen. Anyway, bottom
Keep
line.
in mind, too, I just want to touch on it really quickly, only because our nonprofit, WPBA, is part of the CARES Act where they're giving money. So again, before you go into forbearance, possibly call one of those agencies to see if you can qualify to, and they'll pay your mortgage payment for you. They'll make, maybe a couple of mortgage payments. We've been doing that
Yep,
through our nonprofit. We've made, caught people up and, paid forward, their next 2 payments or their next 3 payments.
Actually, I'm pretty excited to
payments.
say that in the last week, we've paid out almost $30,000
See,
to help
to help
people with their
people with the
mortgage and
mortgage
rent
payments.
payments and utility payments.
So you never know.
There's programs out there.
There are. So, forbearance, last choice. If you don't know or you're not sure, your clients aren't sure, if you're a realtor and, your clients aren't sure, then please call us. Just call us.
You know what's going to happen now? People are going that used to call for refinance, they're going to call and say, hey, I heard you're going to pay mortgage payments for me.
Hey, here you got money to pay my mortgage.
Yeah, let's be careful what we say.
I
So
know.
for those of you who actually watch this show,
You have to qualify.
yeah, that's a whole nother show anyway.
I know.
So that's
So that's the quick update.
quick update on
A
forbearance.
little longer than quick, but
Yeah, but it's important information. So
We told you that we would
if you're
keep you
not sure
updated.
if you're getting in trouble, call us. We'll lay out the options
Just
for
call
you.
us.
You do have to qualify for a new refinance. No
Right.
different than you did before. So you still have to have income. You still have to have hours. We know that self-employed people are going to have to jump through a few more hoops right now. They are going to have to show bank statements. They are going to
Yes.
have to kind of prove that they're still viable as far as their business goes, because a lot of those companies are, hurting. But, a lot of the companies that are those middle line business companies that are selling online through
I know.
through Amazon are thriving right now. Your technology companies
I
are
hear they're doing
thriving
Black
right now.
Fridays, because of COVID, it's all going to be online now. So instead of having Black Friday and Cyber Monday, I think
Yeah,
it was,
people
or
aren't going to
something
be
like that.
allowed to line
Now
up at the
everything
stores.
is going, I know.
What's it going to
everything
be
is gonna
like this
online.
year? It's going to be weird, isn't it?
They said something to the effect of they're going to have not just one Black Friday, but there's going to be various times, because, it would probably crash the world, right?
Yeah. I didn't even think about that.
It's going to be several days, apparently, that there's going to be Black Friday
It's
deals.
going to be a black month. It's been a black year, let's face it. I mean,
It has been challenging was a good word.
I like that word. I
Yeah,
like
I
that
know.
word.
Challenging was a good word, and I think a lot of people out there would agree.
So we have a lot of people asking questions
Right.
on the industry.
And I know we did this last week when we didn't get a chance
we
to
have
get through a
more
lot of
questions that have popped up, so we want to continue on that and let you know some of the questions you may have. And I know you have a whole list of them over there.
So one of the ones that, and some of the stuff that I wanted to expound upon a little bit is,
Expound.
yes,
Got big words this week.
I know,
We've had
for
a lot
a
of
morning,
coffee.
right?
I know. It's been a late night, and
I know. But anyway, so some of the challenges in the mortgage world that we come across when people are qualifying for a loan is student loans. A lot of people have student loans out there. Student loan debt is huge in the country. Everybody knows that. Student loan debt is astronomical in the country. It used to be that if the student loan was deferred for at least 12 months, we didn't have to count the payment. That's changed. VA is the only one who still allows that. But
I don't even
the
think
rest
you
of
can
the
get
world,
deferment more than 12 months now. I think 12 months is the max.
I
and
think
it was
it is,
actually
too.
13 months was the,
Right.
It has to be deferred for 13. It's almost like they were in cahoots when they did this.
all the letters say, it'll be re-reviewed every 12 months.
Right.
So, but anyway, so how do they look at that then? So we have to take a payment. So it depends on who you're doing. If we're doing an FHA loan, we have to take 1% of the balance. That's pretty much what it is. It's either whatever's on the credit report or 1% of the greater of 1% of the balance, whatever's on the credit report, or fully amortizing, whatever's going to fully amortize that loan. So FHA is the strictest when it comes to that kind of thing. On a conventional loan, they're a little bit more lenient. Whatever the payment is showing on the credit report, they'll accept that. So if it shows, they owe $100,000, but they're on one of those income based, so the payment on the credit report shows $300, that's fine. We're just going to use the $300. However, if zero is showing on the credit report for a payment, then under the conventional rules, it's going to be 0.5% of the balance.
Okay. blah, 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 blah. Student loan. First time in our lifetime that student loan debt is expected to pass on to the next generation. It's so great.
Wow.
So think about that. I mean, you're looking at some of these debts for student loans. We see 120, we see
Oh my
200,000.
gosh.
It's going to pass
I wouldn't
on.
sleep nights, I know.
So call us on your student loan debt. Just because your payment's $30 a month, that doesn't mean that's what you qualify for. And when I say us, the industry has this rule. We don't make this stuff up. It's not us. It's not the Barry and DeLynn rules, although we have our own special rules we come up with as we go.
And you know,
We have our PETA bars we don't want to deal with.
so quick, funny little side out.
Sorry.
Quick, funny little story about that. So I had somebody say, yeah, I have to change my questioning. I have to be very careful. And normally I'm extremely thorough on my questioning. And I said to people, and I say pretty much the same thing all the time. Do you have any car payments, or automobile payments, I think I say instead. And I don't say car loans because I learned that people say, no, I don't have any loans, but they have a lease. Well, guess
Right.
what? That counts too.
Yes.
So I have to be very careful in my wording. But I said to somebody the other day, do you have any student loans that you're paying?
Right. Yeah.
No.
Yeah.
He said no, because he wasn't paying them.
Right. Yes.
So I need to say, do you have any student loans that you owe?
Yes.
And
it's just like, do you have a car? Yes. Do you own it free and clear? No. Okay. Then they have payments.
Then we have a payment.
Yes. Yes.
Because people try and hide stuff from that.
But my
from
mother-
us. I know that seems odd, but sometimes they
But
try
my
and hide
mother,
stuff from
I
us.
had this. My mother co-signed for me, so she's responsible for the payment. I said, okay. So you didn't sign it all? No, I signed too, but my mother co-signed, so I don't have to count that, right? No, you do. $440 a month. That's a big payment.
Yeah. Yep.
Yeah, people don't really understand. Again, it's the industry, it's not just us. Okay, another question. That's a great, student loans is a big, big challenge. Call us about that. Well and septic, do we need an inspection?
Right.
So people think, oh, I have a property in Tanglewood, I have a property in Golden Acres, you have some acreage, they're coming up. Do we need an inspection? Now, it's different on conventional FHA and VA, of course, but on a conventional loan, the only time you will need an inspection is if our dear appraiser makes note that there may be a challenge with the system.
Right.
So you don't have to go out and order an inspection for the
No.
well. On VA, well, guess what?
VA, yeah. They pretty much want everything.
Yes. And on FHA, we don't necessarily need one either, but there are the setback requirements.
Again, unless the appraiser mentions it.
If the appraiser mentions it,
Like they put on the water, because on an FHA, they have to make sure the water's running and they take a picture of it. All of you realtors know that who've been on an inspection with an FHA appraiser. So if they smell a funny odor or something like that, they might say, the water
yeah,
was,
stinky,
whatever.
or brown.
Or maybe it wasn't, pressure wasn't very good or something like that. So if they mention something like that, then yes, it would be required.
Have you ever showered in a house that hasn't been showered in a long time, like the water hasn't run, and you turn on the hot water, and it's just like, it's like scary. Like
It is. You're like, I don't want to shower in that.
So
Go to the truck stop.
here's a realtor tip for you. Run the water, run the hot water. If the house has been sitting, get that sulfur smell out because it does build up in that hot water. Heater tank, don't know how, talk to our plumber partners and friends out there. They'll tell you the solution on that. So anyway, well and septic. If the appraiser makes note, we're going to have to get it checked out and possibly an inspection. So,
And the only other thing we wanted to mention about well and septic is on an FHA, there's certain setback requirements. It has to be so far.
I said that.
The well and septic so far from each other. I know.
You
but
wanna
I kind of
elaborate
cut
on
you. No, I cut you off.
That's
so I
fine.
apologize.
You're good. You're good.
And it has to be so far from the road. So again, if you do happen to take a listing of a house that has well or septic, you might want to just get brushed up on the setback requirements in case you have an offer come in under an FHA
And those
loan.
usually only come up on the older properties because I think,
Exactly.
nobody's going to put.
Or on mobile homes. So it's not, and people think, oh, it's just because it's a mobile home. No, it's not.
And we
it's
talked
just
about
an
last
FHA
week,
rule.
if there's a mobile home on a lot with a home, what do we do?
You have to have it removed.
Yeah, back up. And that doesn't mean just go
You don't
get your.
take the listing.
Don't get your $350 and tow it out of there. It has to be removed from the parcel. So that comes up here and there.
So the other thing that we wanted to mention that we've had questions on this as well, flips. So everyone pretty much knows the FHA rule on flip, 91 days, right? Say it with me, 91 days. So FHA won't even do a loan if the house has changed ownership in the last 90 days. So we have to wait until the 91st day. And mind you, this is the other question I get. It goes by date of contract. It does not go by closing date. So you can't say like, okay, well, we get to 60 days and then by the time we closed, we'll be at 91 days. No, that's not how it works. You can't even have the contract signed prior to the 90-day mark. However, on a conventional loan, 1 day.
Yep, 1 day out.
1 day out, and you're fine.
And again, if there's a huge increase in price, it may be subject to a second appraisal. So keep that in mind. On FHA, if it's between 90 and 180 days, they will require a second appraisal, which you realtors can choose that appraiser if so be it. It does not have to go through an AMC on that second appraisal. So keep that in mind when you're looking at flips. So in my mind, right now, people say, I can't go FHA, I don't want to go, we're not accepting FHA.
I know.
That's the only reason why you as a seller should not accept an FHA contract. I'm sorry. There's no other reason.
I know.
They're not harder. They're not difficult. The inspections aren't more. Get it out of your head. You're thinking old school. FHA, there's nothing wrong with the loan outside of the flip. The flip rules will prevent it. And it may be a better option for your buyer to go FHA over conventional, especially, and I say this over and over, scores under 700, it's probably going to look sweeter on an FHA deal. And the other reason is...
Yeah, it's not that we can't do them in a conventional world. It's just that it's probably going to be a better deal for the borrower.
Loan size would be the other reason.
Right.
Because FHA has the loan limits.
Right, loan
per
limits.
county. They are going to be lower than the jumbo limits on conventional. But outside of that...
I know.
No, don't do it.
I know.
Don't be afraid of them. Okay.
I know. So the other thing I wanted to touch on, some differences, gifts, okay?
Oh,
and this
you
is where
love this one.
I know. This is where you realtors can help us out. So a lot of times you guys already know ahead of time the people, because they share some stuff with you as well. And I know a lot of you don't even want to know about any of that. But I also know that they share some stuff with you. So the things and I know that you guys love helping us out. You'll tell people, don't get any car loans, don't let anyone run your credit, don't do anything stupid. So here's something that could help us out. So if they say, well, my mom and dad are going to be helping us out with the down payment, things like that, don't move any money ahead of time because we have to track it. So we would rather wait on mom and dad giving them money. If they're buying in the next 30 days or something, you have them out every single weekend and they're like, narrowing it down to a couple. Don't move the money until after you talk to your loan officer because we need to track it. So I'd rather do that. And depending upon which loan program we're going with under an FHA, they're a little bit stricter. We have to have with both of them, we have to have what they call donor ability. Make sure the donor, mom and dad, whoever it is, has the ability to give them the money. But on FHA, we need to see mom and dad's statement and see it coming out. Under a conventional loan, we just need a copy of mom and dad's check, and that's it.
You are so passionate about that moving money. I hear you talk to people, I'm like, if they don't understand not to move money, because for the longest time it's frustrating because people just do it.
Well, and you know what, and it comes up all the time, and I tell people in the beginning when I'm talking to them, I'm a really nice person. I promise you I'm a really nice person, and I'm very good at what I do. But you're going to think I'm driving you crazy on this, but I promise you it is not me. It's the industry, and I want to make sure your transaction goes smooth as well. You want to make sure it goes smooth, and I want to make sure it goes smooth.
And they always listen.
You have to listen to me.
They
You
always
have to listen to me.
Every time.
No, they don't.
Right. I know. All right, so here's another question that comes up all the time because people are trading down in houses and trading up. What do I do? Okay. Can you count income from your primary residence to buy another residence? In other words, can I get a lease? And the answer is yes, you can. So
rent out your current property.
Your current property If you are not going to sell it for whatever reason and you want the cash flow, you can actually get a lease on it, even if you don't have landlord experience on a conventional loan. And we can count that as income to offset that debt. Okay, we can't use it to give you more income, but we can use it to offset the debt. The rule of thumb is 75% of the lease amount. So if you're leasing the house for $1,000 a month, we're going to give you 75% of that gross income, $750 credit. That's a pretty good guideline. So maybe you don't have to sell that existing property. I know
Right.
your realtors aren't going to want to see that, but maybe that's the best thing for your buyer. You know, I know you all like to have a double transaction, but sometimes it makes more sense for people to hang on to that property for whatever reason.
And you know, the other thing, kind of going right along with that, you know, where they're, you know, selling this house and buying another house, or renting their current house to buy another house. Something I've been seeing coming up a lot lately is they kind of don't necessarily want to sell this house until after they buy the new house and they move out and they have a chance to, like, you know, take their time moving or whatever. They don't want the pressure of having, well, we got to sell this the same day we buy this, and that's called a simultaneous close. And yes, it's a lot of pressure. And they're like, but I need my equity from this house to put down on the new house, right, for my down payment and everything. Well, there's options for doing that as well. So they used to call them, years ago, they used to call them bridge loans. Not that that phrase is coming back, but there's a couple of lenders who can do it as a home equity loan. So there are some options. So don't think, again, you know, if you have someone who is in that situation, don't think, oh, you know,
We actually have
they
that.
can't do this.
We do have the bridge loan in our portfolio.
See, it's coming back.
Yeah, we have it.
It's becoming more
I was
popular.
looking at it.
Obviously, they
It's
have
crazy.
to qualify for both.
Yep.
You have to be able to carry both mortgage payments, like we touched on last week, I think. But it's doable.
And you can pay off debt to qualify. That's another
Oh,
tip.
that's another one. Yes.
You can pay off debt to qualify at closing, whether it be a refinance or purchase. Comes up a lot. Okay, enough tips for this week.
Did go fast,
Yeah,
didn't
we
it?
went by super quick. I know we're trying to give you a lot of information every week. We have our upcoming Lunch and Learn going on November 10th. It's going to be on our Quick Qual app.
Which is an amazing app that our realtors who are using it love it.
You're going to love it. It's going to help you with your business. It's going to help you get a pre-approval at Sunday night and 2 in the morning. It's pretty impressive. Check it out November 10th, 11:30 via Zoom. Go on the mortgage firm Trinity's website. Check it out. Get the link. And don't forget, check out our nonprofit partner, WPBA, at WPBA.biz, helping people in the community right now with CARES money. Pretty amazing.
If you know anyone who is hurting and could use our help, please let us know.
So don't forget, share this show.
Thank you, everyone. We are today and every day.
Moving forward.
See you next week.
Have a great week.